Hey everybody, welcome back to the channel. Today I've got Lori Stanjevich here with Supreme Lending. She is a loan officer. And Lori, you've been doing this for a little while, right?
20 years.
20 years. How much of that time has been with Supreme Lending?
13.
13 years. And before that?
I was part of Home Bank, Countrywide, and Bank of America.
Well, fantastic. Well, I'm glad to have you here. The reason I asked you here today is 1 out of 4 home buyers right now are a first-time home buyer. And they're going through this experience for the very first time. And I know they're going to have a lot of questions about what to expect from the mortgage process, where the potential hiccups, what help may be there, who do they go to for answers, all those sorts of things. And so you've been doing this for so long, I couldn't think of anybody better to answer those questions. So let's just start out with one everyone wants to know. What are the main factors that determine whether or not somebody can actually get approved for a mortgage?
Well, the first factor is there are 3 things that we look when we're qualifying somebody for a home. One is credit, one is income, and then the third piece is your debt to income ratio, and that is literally a mathematical formula based off the first 2 items. So income is the one thing that determines what you can buy. Income determines the amount of all the debts you can have, house, student loans, credit cards, all the debt. The income sets that limit.
Okay.
So that's the first one we start with, income and credit.
Gotcha. And what are the typical steps that somebody's going to go to in applying for a mortgage?
So we can either, we can work online, we can work via phone, we can work in person. The first thing we're going to do is start with doing a soft pull on your credit. Doesn't affect your credit. We do a soft pull just to see what's there, to see if we are able to move forward with a loan.
Okay. So a soft pull as opposed to a hard pull.
Correct.
Soft pull doesn't affect your credit.
Absolutely.
Hard pull would affect your credit.
A little bit, yes.
Okay.
And then we ask the questions, what type of income they have. Are they employed or self-employed? Are they hourly, salary? What kind of income they have. So that's really important because sometimes income is not usable. Sometimes it is. If they're self-employed, we all want to take advantage of the tax code. So it's just a big deal that we start with getting the data.
So you mentioned self-employed, and some things being included or not included. As a potential buyer, how would I know that information?
It would be getting with the lender.
Okay.
Because a lot of times CPAs will say, oh, this is good. It's good if you don't pay taxes. My phrase is always, your CPA does not set you up to buy a house. Your CPA's job is to not make you pay taxes. So not paying taxes is not always the best thing to set you up to purchase a home.
So the best person to answer your questions about a mortgage is going to be a mortgage lender like you.
That would be correct.
Right. Very good. So when should buyers that are looking to buy sometime in the near future, when's the best time for them to apply?
Immediately. It's always immediately. Today's the best
Immediately
answer.
when I'm ready to buy, or
immediately now when you're starting to think about it, because let's just say you are self-employed. We're just talking about that. If you are self-employed, then what are your tax returns look like? Let's see what last year's look like so we know what to file this year. Or if you don't want to take as many deductions so that you can buy the house that you want. If your salary job and you're thinking about going to a commission job, you need to talk to us first. Changing jobs could cause something to affect it. If you have a credit issue, maybe you didn't know you had a credit issue and now you have a credit issue, maybe an old collection or you didn't take the DirecTV box back, something could happen that's on there. And
sometimes things show up on your credit report that should have never been there in the first
Correct.
place. There's mistakes and errors there.
And so we can give you a plan to get that fixed or get it off because your credit score is going to make your interest rate either higher or lower. Your income's going to affect the amount you can buy, but the credit's going to affect the terms.
All right. Now I know the answer to this one, but I know some of the people in the audience won't know. So you hear the phrases bandied about pre-approved and pre-qualified. Mm-hmm. And today they're really used interchangeably.
Correct.
And so I'm not so focused on which one pre-approved or pre-qualified, but there's really 2 different levels of
Absolutely.
approval. What do those 2 look like?
So a pre-qualification, I've pulled your credit, you've told me that you're make $100,000 salary, and I'm like, okay, based off this salary, you're pre-approved, pre-qualified. to go look for a house.
Right.
A pre-approval, now I'm going to get your pay stubs, I'm going to get your W-2s, and I'm going to send them to an underwriter and have them completely underwritten, and they validate you do have a job, look at all the documents. If you're self-employed, pulling the IRS transcripts to make sure they match, and then we can issue a commitment letter, which means you've just got much quicker to close and much more buying power.
Yeah.
Or speed.
And some people will call it pre-approval a pre-qualification, some will call it
Correct.
pre-qualification. But really it's, I've gotten the information from you and it looks like you fit the program. The second level is we've already done all the work.
Correct.
We know
You're
we're going
good
to give
to
you this
go.
loan. You just have to go find that property.
Correct.
So that first tier of it looks like you're going to qualify. How long does it take for that process?
To pre-qualify,
Yeah.
less than an hour.
Gotcha. And that pre-approval process that
Might
more
be 3 or
rigorous,
4 days.
3 or 4 days. And you should definitely have at least the first one done before you even start looking at
Correct.
houses.
Because
Yeah.
you don't know what you're going to look at. And after you go look at a $400,000 house and you can only afford a 3, it's going to be much harder to adjust to that.
No, that makes sense. So if I'm a buyer and I'm applying for a loan, we've got those 3 categories of credit, income, and our debt to income ratio. What's the minimum credit score that you have to
Depends
to
on
qualify?
depends on the program. FHA has a minimum of 580. Conventional has a minimum of 620. Like if it's a bond program, it might have a minimum of 640.
And you're throwing away around some
Oh,
terms
sorry.
that people
I'm so
won't necessarily
sorry.
know. But there's different types of
Yes.
loans. There's not just one type of mortgage.
Correct.
And so depending on what mortgage, you have different criteria that you have to meet.
Correct.
And as a buyer just stepping in, am I intuitively going to know what type of loan is the best match for my situation?
No, but that is what my role as a loan officer is to determine what product best fits the customer. Sometimes it's based off credit score, sometimes it's based off debts. There's not a right or a wrong. They're both 30-year fixed. It's just a matter of what program guidelines fit that particular customer the best.
And each of those programs, based on the risk that the lender's taking, may have different
Correct.
rates attached to them.
Correct.
Well, as a general rule of thumb, if I were looking to buy a home, what sort of income? Is there a ratio or an idea that you can give me on how much money do I need to make to buy this type of a home?
Yes. So the amount of money you need to make is based off your current debts. Okay. So ideally, if you read or look around or research, they'll say you want to keep your housing payment below 30% or 35%. Now the guidelines will let you go to 45%.
Okay.
So it's really, what is your family budget? Where do you want?
And what's your comfort level?
Correct. So if you want, some people want a $3,000 house payment, but they can afford a $2,200 house payment. And some people can afford, a
$3,000 house payment,
and they
but
only
they
want
want a $2,200.
correct. So it all depends on their debts and what their income is. Typically, if someone's making $40,000 a year, they're not going to probably qualify for a home unless they've got a co-signer.
Okay.
So it just depends on their family budget. But if
And their debt.
and their debts,
And their debt load.
correct.
But if you want to just a ballpark, if you took what you make a year and you were to triple it, that's probably going to put you in about the
30%,
right ballpark,
correct.
right?
Yes, correct.
As far as debt to income ratio, what's that? That's got a cap. So
Correct.
we want the housing to be between 35 and 50%.
Right.
There's also a maximum amount of debt that you can carry, and that's a ratio 2.
Correct.
The debt to income ratio.
Right.
What is that ratio requirement?
It depends on the loan again.
Sure.
So everything is going to depend on the type of loan because each loan's got a different limit
Right.
of what their risk level is. So with a typical, let's just say an FHA loan, a first-time home buyer loan, FHA, if you have really good credit, the debt to income ratio can go to 56% of your total debt. Gross monthly income, the total debt, that's the house, the car, the student loans, credit cards, that's everything.
Okay.
So if the credit score is lower, then it may only be a limit of 45%. So everything is going to depend. So the better the credit, the better the terms, or the more house you can buy.
No, that's awesome. And then the different loan programs also
Mm-hmm.
have different down payment requirements.
Correct.
So what's that range typically look like? What's the minimum that someone
Gotcha.
could do, and what does it typically go up to?
Well, FHA financing, the minimum is 3.5% of whatever the sales price is.
Okay.
Conventional will let you do a 3% if you're a first-time home buyer. Second-time home buyer or beyond, its minimum is 5%. So a lot of people think you have to put 20% down, and you do not. So there's a lot of programs out there but you can do 3.5 or 3 is the minimum on most. Or a veteran, if you happen to be a veteran, you can do 0% down.
As well as with the
USDA,
USDA loan, but
correct.
that's only in
Geographical,
certain
yes.
geographic areas that you can do that. So what are the cost and fees that as a buyer coming in, I'm gonna have to pay for some things along the way, not just the down payment.
Right.
What are the other costs that are associated with buying a house that I need to plan for, budget for?
Excellent question. So planning for what else you need, I usually tell people to average about 5%. It could be 4%, it could be 3.5%, it could be 5.5%, depending on the day of the month. If it's in a homeowners association, because the fees, there's about $4,000 worth of set fees in the state of Georgia that are going to be there regardless of the price of the house. And then everything else is based off the sales price, the loan amount, your homeowner's insurance, the taxes. Everything else are not set fees. So the bigger house you buy, the bigger the fees. But give or take 5%. So if you were looking at a $300,000 house, I would normally say it's about $15,000, could be $13,000, could be $17,000. We do not know the data. Once you tell me a house with an address, a homeowners association, real taxes, I can get you within $500 because all those fees are not our fees. That we have our lender fee at Supreme Lending is $1,400. So if I tell you they're $15,000, they're not my fees. They're not negotiable. You can call the state of Georgia if you want, but I don't think they're going to negotiate with you. Same thing with the attorney's fees. Those are pretty much set fees for that particular work, and everything else is percentages.
Okay.
So 5% is a good range on top of your down payment.
Now is that money that I have to bring to the closing table?
Yes.
Okay.
So some of that, so if I'm guessing, some people have a lot of antique toys. I had a customer recently with antique toys. His homeowner's insurance was a lot higher than typically because he wanted to insure all this. Maybe somebody's got a lot of guns. Maybe somebody's got a lot of jewelry. That homeowner's policy may be higher, and that is part of that closing cost.
Okay.
Those are prepaid items, but they're due at closing.
Because the lender's going to require you to have home insurance.
Correct.
So depending what your home insurance, that can affect everything
Correct.
else. Now with that, there's some other things that they need to plan to pay for. So once we find a house, typically the first thing they're going to pay for is an inspection.
Right.
Right. That's more
Yes.
the agent's purview. But then you're going to ask them to pay for something as well.
The appraisal. So the appraisers are independent contractors, and they will send you a link to pay for the appraisal to get it completed. And that could be $500 to $700, but a larger square footage, a larger plot of land. They do not work for the lender in any company. So they are independent contractors, and so whatever that price is, but it's usually common, probably $500 to $700.
Okay,
And
and that's something they need to plan to pay for long
Correct.
before closing, and whether or not they buy the house or not. So they
Correct.
make an offer and they want to continue moving forward, they're going to pay that.
Correct.
No, very good. Two other pieces of vocabulary: private mortgage insurance and mortgage insurance premium. For a new buyer, probably aren't familiar with what those are. What is PMI and MIP, and what's the difference between them? And,
Okay.
And do I have to pay it?
Unfortunately, yes. So, except if you put 20% down on a conventional loan, there is no private mortgage insurance or PMI.
Okay.
On a conventional loan, anything under 20% down, you have the private mortgage insurance or PMI. And on a conventional loan, for every 20 points that your score is better, the PMI gets cheaper.
Okay.
So it's super important to have it, like if you've got a 719, it's not a 720. 720 is going to have cheaper PMI than 719, or 749. It's every 20 points. So 759 is going to actually be more expensive than 760. So when people say my score is about 720, if it's 715, the PMI is going to be different.
So your credit score not only affects your interest rate, it can also affect your
PMI, correct. And so then with FHA has both PMI and MIP. So the PMI is a monthly figure on FHA, the FHA loan. It's the same monthly percentage whether you have a 580 or an 800.
Okay.
It doesn't change. So that's one of the factors sometimes when we're, as a loan officer, trying to decide, should we go FHA or conventional? If they have a 640 credit score, it's going to be way cheaper for them to go FHA than it is to go conventional because of the PMI.
The fixed PMI.
And so the MIP, mortgage insurance premium, both FHA, VA, and USDA have upfront fees that they charge the borrower upfront, rolled back into the loan amount.
Okay.
And so
that's not money I have to bring to the closing
No,
table,
sir.
But it is going to increase my payment over time.
Correct.
And that's an insurance not to protect me. Right?
That's correct.
Who's that insurance protect?
It protects the lender.
It protects the lender. So if something were to happen to the house, then that lender's able to be made whole.
Correct.
But the buyer's the one that gets to pay for it.
Correct. Absolutely.
No, that is great. So for those first-time home buyers out there, and again, I don't think most people probably know this intuitively. When we talk about first-time home buyers, it doesn't necessarily mean it's your first time ever buying a home.
Correct.
Who all is considered a first-time home buyer?
Anyone who has not been on the title to the house in 3 years.
Okay.
So if you
on any home.
On any home. So even if mama added you to their house because they're getting older, you're a homeowner now. So if you're on a title at all,
doesn't matter if you purchased it, if you were added and on title,
then you're a
don't
homeowner.
qualify. But if it's been 3 years since you've been on title,
You qualify for all of that.
you moved from another state, you rented for a few years
Absolutely.
to figure out where did you really want to live. Well, you're regarded as a first-time home buyer again.
Correct.
Which potentially qualifies you for some first-time home buyer programs that are out there.
Absolutely.
So what are some of the programs out there right now for first-time home buyers to help them get into a home?
So one of my favorites is Georgia Dream in the state of Georgia. It will give you either $10,000 or $12,500 depending on what you do. So if you're a police, educator, nurse, that will give you $12,500 or up to 6%. If you're buying a $150,000 house, it would only give you 6%,
Okay.
up to $12,500. It's never forgiven, but it's interest free. It's free. I mean, you get the money to help you buy the house, and then it will grow. When you're there for 10 years or 5 years or 20 years, you will pay that back. But there's no interest on it or anything else. You sell it, you pay it back.
So essentially, Georgia Dream is making an interest-free loan to me.
Correct.
For me to use as my down payment or towards my down payment on the house.
Correct.
And
Absolutely.
I don't have to pay that back anytime soon, just when I sell the property.
Correct. And they do not take a percentage. If it increases in value, there's no percentage that they get higher. They get their money back when they sell.
And in addition to the help with the down payment, is there any help on the rate or
It's
being
usually
better loan?
typically a lower interest rate. It's the play right now. It's a great rate. It's now cheaper by about 1% than the going rate out there on FHA. So it's a very attractive product. There are income limits, and it's household income limits. So just because, say, you live with your fiance, it's still household income limits. And if they find out you're living together, like by money being in the bank accounts, they've got their ways. But if they find out.
And with that household income limit, would that potentially include your teenage kids?
If they were working, absolutely. Or mother living with you on Social Security. But there are some programs that do not have down payment, that do not have income limits. And some that you have to pay it back. So we've got a wide array. There's also some grants out there right now, and it's based off where you live currently, not where you're buying. So if you're doing a conventional loan, we type in the address, and if your address says yes in the box, then you get $8,000. Just had a young couple close on their first house that just got $8,000. They had no idea. I punched it. I'm like, you don't believe it that you qualified for this grant, and they were so super excited. They decided to fix the flooring and get their house painted with that $8,000.
That's awesome.
So it's just, they made it their own. So there's a lot of stuff out there that's available. And some of it's countywide, some of it's statewide, some of it's across the board.
So to me, the thought of going online, love Google, love search, but trying to find what programs do I qualify
Right.
for, I would imagine that's not an easy task to do.
No.
So if I'm a buyer and I'm thinking I may need or want some down payment assistance, some loans, a grant,
Right.
who would I talk to about
The
that?
loan officer, come see us, because you hear a lot of noise out there on social media, a lot of things that are out there that say this $15,000 is available, this $10,000 is available. But some of those grants that are statewide are based off of area median income, and that is set per state by Fannie Mae. So you can look up the link, and it'll tell you what the area median income is. Some of the larger grants are if you're under 50% of the area median income. And that's pretty tough to be that low to still buy a house. But if you had zero debt, great credit, it is an option out there.
But a loan officer, a mortgage company is going to be your best advisor on
Absolutely.
that. No. And not every mortgage company out there is willing to put in the work to do those types of programs.
Correct.
So what are some of the trends right now around rates? What could a buyer stepping into the market today expect?
Well, we've stabilized, so now that the election's over, it should be stable for the next little bit with pricing, and then it doesn't matter which side, it matters that it will eventually, the next 9 quarters should all be positive in home sales and home growth. That's been traditional. But they are predicting rates to slowly decline over the next 18 months, so hopefully we'll land somewhere in the fives, low fives. But if you wait, then the house prices are continuing to go up. So it's always a good time to buy if it fits your family budget, but don't wait. My philosophy is always don't wait.
So even though rates are going down, it's not necessarily the best financial decision to wait till the rates get down.
Correct.
Because home prices are going to go up, and you're also missing time to take advantage of home appreciation.
Correct.
That takes place over that time. So talk to a loan officer.
Yes, talk to a loan officer.
Talk to a real estate agent. Find out what you're hunting for. If rates do go down, am I stuck with the rate that I have?
Absolutely not. You are always free to refinance your home. And one thing with Supreme Lending, we offer a 2-step refinance. So if you do your first loan with us, you'll get $2,000 up to $2,000 off your refinance when you go to refinance your home. And
which pretty much covers
a good portion. It covers all the lender costs. We can't control the state of Georgia or the attorney's cost or any of that, but it covers all your lender costs for the most part.
So that refi will be a pretty low cost decision to.
Absolutely.
So at what point, how much do rates have to drop for it to make sense to refi?
I usually try to tell people 1% to 2%.
Okay.
So if you're at a 7 and you get to 6, you may want to do it. You may want to wait till 5.5 if it fits your family budget. But some families that $300 makes a difference now.
Yeah.
So you may refinance now and then refinance again later, because it's all about what fits your family budget.
That makes sense. So what are some of the most common issues that you see buyers make, or issues that come up through the mortgage process? Because this is a process that you go through. What are some of the things you see that kind of get the train off the tracks?
Not listening to your loan officer. That's the first one. Giving me documents in a timely fashion. Like, people want to say I make $170,000, and then you get their pay stub and it says you make $120 and it's bonus, and you do not have a 2-year history. That's a problem, because in your mind you make $170, on paper you make $120.
Yeah.
Or
and as a loan officer, you need to know that as early as possible. And it helps protect the buyer to discover that as early as possible while they're still in their financing contingency, as long as they're in due diligence before they're committed and put their earnest money at risk.
Because Supreme Lending underwrites up front. So we would know that usually within the first 5 to 7 days. A lot of companies out there don't underwrite until the back end. So you're already past your financing contingency. You're a week before closing when the file finally gets to an underwriter, and then they find it out. Oh. That's just not good news.
Where Supreme Lending starts underwriting the moment you get the documents. Correct. So as they come in, as they get added to, you take them one piece at a time, and don't wait till you have everything to start looking for problems.
The second biggest piece that I see is in Georgia, there's a lot of people that the money's not in the bank. Physically, it's not in the bank. It might be in a safe deposit box. It might be in a safe at home. It might be
in a mason jar in the backyard.
A lot of the times it is in a safe, and that's okay, but you cannot use cash in a transaction. And a lot of people think if I take this cash and go turn it into a cashier's check, now it's a check. Well, we still have to source how we got the check.
Yeah.
So just again, fess up, tell me the truth, we're the filter. It's because you need to get the money in the bank. So the banks care where that cash came from. They may have to turn in reports to the government. So you just need to get the money back in the bank, out of the mason jars, out of the mattress.
And it's because the banks want to make sure the money's coming from a legitimate
correct
business, legitimate earnings.
Yes.
And something like that. And with that, it takes time. We can turn cash into traceable.
Correct.
It just has to be seasoned.
Correct.
Right? It has to have some time in the bank.
Now, if you sold a car and the guy gave you $25,000 cash and you have the cash, you can go to the bank and fill out a form that it was cash.
Okay.
Like you can do that, but it's like
you have to document. You
correct.
have to prove that there's a legal and good reason that you
correct.
had that cash.
Correct.
The other thing that applies to your earnest money that
correct.
you put down
absolutely.
when you make the offer, as well as your down payments.
Mm-hmm, absolutely.
And disclosing where all the funds are coming from. One that I've seen become an issue is gifts. So parents have given gifts and the loan officer didn't find out that it was going to be a gift until later in the transaction, and that caused problems and delays.
So the rules have lightened up a little bit in the last 60 days. FHA no longer requires the donor's bank statement, whereas for the last 5 years, if mom was giving you money, we had to get mom's bank statement. We still have to trace the money. So if mom wrote a check, mom sent through Zelle, that's okay. But if you can't just go into the family safe and pull out $10,000 and give it and say, my mom gave it to me. It would have to go into mom's bank account and then come out, but we still have to trace it.
Okay.
So I usually ask people, my favorite phrase is, how does mom want to give it? And I'll tell you what we need to document. Again, just get with your loan officer, because I may say wire it to closing is the best, which is, but if mom doesn't want to wire and she wants to write a check, then I need to tell mom what she has to do.
Okay. No, that's fantastic. So kind of wrapping things up, what are the best pieces of advice? Just the little nuggets that you want to make sure anybody listening in is going to know.
Just always tell your loan officer everything. Never try to hide anything from your loan officer. It's our job to guide you through the transaction. We're the guide. So if you'll just tell me everything, I can tell you what you need to do to fix it.
And you want to get them to the finish line.
Correct.
Yeah. Because how much money do you make when the property doesn't close? Zero. So you have an interest in getting it to the finish line as well. So you're on their side the whole step of the way.
And I think that's where it is. It's not them versus us. It's like if you're using child support, for example, as a source of income, we have to document the child's age. So if it's not in the divorce decree, it's not anywhere, we have to have the birth certificate. So some people don't want to give public information, private information, but if they don't, then we cannot use that income. And that's the biggest thing, is people want to hold back. I don't want to give you that. Why should I give you that? They're not my rules, they're the rules.
Yeah.
Like Fannie Mae and Freddie Mac are setting the standards. Here's the documentation we need to get a loan, and for some reason people think they don't have to give it to us, but they want to borrow $300,000 or $400,000. So
yeah, if you want the bank's money, you have to do what the bank asks you to do.
correct.
So any other piece of advice you'd want to add?
I just think just communication with the loan officer, the real estate agent. Just everybody's got to be on the same page. We're all rowing in the same direction.
Sure.
So, and it goes very, very smoothly when we're all rowing in the same direction.
Yep. One other thing that I want to address, and I've seen just lots of people lose money to this and not get the best advice, but there's companies out there that offer credit repair for those people that have some challenges in their credit. What are your thoughts and what are your advice around paying somebody to help you fix your credit?
So your credit is, I always tell people, it's like if you cut your hand, it's bleeding, then You stop the bleeding, it scabs, it scars, it's like it never happened. When you've had damaged credit and you have late payments and now you're not late on a car payment, you've stopped the bleeding, but it still has to scab, scar, and heal. Same thing, so if you've got old collections, that might not be the first thing you need to work on if you've got late payments somewhere else on your credit report. So I'm not a big fan of paying for your credit to be fixed because they're going to dispute everything and your score rises. But when we get it, we're going to say you have to remove the disputes, the score goes back down. I'm not a big fan of believing to fix it at all, to pay to fix it, because we have a lady that works for Supreme Lending, Lisa Myers. She's worked for the credit bureaus for over 25 years. If we have a credit report that's challenged, we send it to her. She comes back with a plan saying delete, pay this off, pay this down. She'll tell us exactly what to do.
And that cost how much?
Zero.
So that's my favorite price.
Yeah.
So don't go pay somebody for credit advice or
Correct.
doing things. Talk to you. Talk to a loan officer that's looked at your credit, that knows,
That's educated.
and is willing to give you, because there are people out there that will give you that advice for free.
Correct.
And then you're getting good advice from somebody that wants you to get the loan.
Absolutely.
And wants to help you. No, that's good. Well, thank you, Lori.
My
I
pleasure.
appreciate you being
Thank
here
you
today.
for having me.
Hey guys, if you got value out of today, please click the like button or subscribe to make sure that you don't miss the next video. We'll talk to you soon. Thanks.
Bye-bye.